Merryn, hi. Fantastic to be able to chat today. Lots of people are going to be very familiar with your work, and that might be via the very popular podcast that you now run, Merryn Talks Money, but also you've had that long, I think 15 years of writing for the FT at the weekend, and hopefully people will have read one or two of your books as well.
Hope
And if I were to summarize your sort of trademark style, you may not agree with this, but I would say it's incisive. It's really trying to use plain English with sharp analysis and trying to get to the bottom of what matters to financial investors. And so I think there's no better person to talk to about the kind of challenging world that UK financial consumers find themselves in today. But I thought perhaps to kick off, it would
Mm.
be helpful to think about, are the challenges today really any different? You've lived through multiple economic cycles, obviously, as have I. And so is there anything that makes today unique, or how do you think about that?
No, the underlying challenges remain exactly the same as they have been throughout my whole career and for the last couple of hundred years for savers and investors. How much do I save? How much do I invest? When does saving turn into investing? How do I educate myself around that shift? If I'm going to invest, how do I allocate? How do I manage my taxes? How do I distinguish between money I need in the near term and money I need in the long term? You have to always think of your money as a bit of a time machine. And when do you need to exit the time machine along the way? And with that in mind, how do you invest for each of those time frames, etc.? All these challenges are exactly as they have always been. The bits that change along the way are the tax regime, for example, and we have a sort of almost uniquely complicated and at this point punitive tax regime in the UK. How do you work your way around that? How do you manage it? How do you, if you're looking at the long term, also think about investing in such a way that you leave something for your children? And what vehicle do you use to leave something for your children? It's all these things. And then when you're starting today, you also have the challenge of the extreme volume of information. Previously, people would say, how do I learn about investing? Where do I find out about this stuff? How do I do something without paying for an expensive IFA? And now you sit there absolutely buried under a tsunami of information, and your challenge is which part of this information is even vaguely correct. Is it possible that the stuff I saw from the you know the word I mean, finfluencer on
Influencer,
TikTok.
that's the one.
Finfluencer, that's the one.
You are a finfluencer.
I'm a finfluencer, but I'm not on TikTok. Maybe I should be on TikTok. Is it possible that the stuff you saw on TikTok is true, or is it more possible that the stuff you heard on the Merryn Talks Money podcast might guide you better? It's very hard to distinguish, particularly if you're new to markets, what is true, what is not true, what is sales, what is reality, what is advice. So I think that is a new challenge for modern investors. It's not lack of information, it's overload of information.
So actually, I couldn't agree more. And on that basis, going back though to what's different and what's not different, how would you then summarize, actually cut through the noise? What would you say if you're feeling a bit dazed about all of this? What are the main things to focus on?
Oh, let's go right back with that, okay? Because I think we've talked to you and I in the past about education and personal finance, education in schools, etc. And I think it's very hard for people who are involved in business or in finance to understand how little people in different areas really understand about even what economics is. So let's take, for example, what is a share? Now, you can't even believe that question is askable. But for the majority of the population, what is a share? What is a company? How does a company work? How do I own a share in a company? If I own a share in a company, what does it mean? What is the difference between a public market and a private market? And what even is a stock market? These are things that people really don't know. You're not taught these things in school. You're not taught them at university. You're somehow expected, as you grow older and you move into your 20s and 30s, you're supposed to know what a share is. You're supposed to know what a company is, what a limited company is, what a listed company is, what a private company is, what a bond is. I mean, we know that most MPs don't have the faintest idea what a bond is, right? And we know, and an awful lot of MPs don't know any of these things. And one of the things that I often talk about is that new MPs, just as one example, should have to do a 2 or 3 or 4 week course before they're even allowed to cross the doorway into the House of Commons, where they learn what an interest rate is, what it means, how it works, what the price of money is, what a bond is, why we care about bonds, why we care about yields, what the difference between a yield and a coupon is, what a share is, what a dividend is, the difference between net and gross profits. All these things, they are so important. And you get right down to that base level of knowledge. And most people don't know. So we talk to them about investing, but the building blocks of investing are mysteries to most people. And that's where you've got to start.
So I think actually it's fascinating. I'm also having a conversation with somebody about and adolescents and whether or not how they should be interacting, whether there should be bans and so on. And one of the points that she talks about is that actually this is about those who are in charge of educating, let's call it, so schools, universities and so on, are often less well appraised than the people that they are trying to educate on these particular subjects. And actually financial literacy is absolutely one of those subjects, I think, where it's not taught at schools. And part of the reason is that, as you said, people aren't necessarily that comfortable with it. So maybe just moving along with that understanding and recognition that there's too much information and a lot of misunderstood. What would you say are the sort of classic behavioral traps that people therefore sometimes fall into? I would say one of them, for example, is this idea of chasing markets, timing markets, thinking I can make a quick buck. And part of the reason for that is they hear about crypto, they hear about gold, and they suddenly think that's all I need to do is put my money there and all will be well. So that would be one in my view.
Yeah. Just be clear, sometimes you can make a quick buck.
Yes.
You know, sometimes you can.
But maybe you can't repeat it.
You can make a lot of quick bucks, you know, if you got into gold at the right time, got into silver at the right time, got into crypto at the right time, uranium at the right time, you know, timed things properly on the turn in software companies, whatever. There are loads of places that you can make a quick buck. The problem is that mostly you won't. And an awful lot of the time you'll lose money rather than make money. But one of the things that we might come back to this, but one of the things that I think is really important is that we don't always focus on the losing of money. One of the things that the regulators have done in the UK is taken all the ability for people to be responsible for themselves out of the equation. And we have endless risk warnings. And every time you tell people about investing, you immediately have to tell them up front that they may well lose all their money. You could lose all your money. Your capital is at risk. What we don't tell them enough is if you don't put your capital to work, your future is at risk. Right?
That's right. That's
right.
Much particularly
more
true for women.
Important. Much more important. So I often feel that the emphasis from the regulator is on the wrong side. So the regulator tells me that fund management companies and investment companies possibly take their regulations too seriously and go too far on the negative because they're so risk averse because of the environment in which we live. So that's something. We put that to one side. So yes, absolutely. That is a really big part of it. The idea that the confusion between trading and investing, the confusion between the short term and the long term, the idea that you can time the market, all these things. And the other thing that I think people get confused about at the moment, and again, we're talking about people who have a certain amount of knowledge here already, is passive investing and active investing. And I know this is an area that you think about a lot, but I am forever telling people there is no such thing as passive investing. This doesn't exist. This does not exist. You cannot even just put your money into a global index like the MSCI World or whatever and think that you are picking up a passive position in the global market that is in some way representative. You are not. You absolutely are not, because first, you're a momentum investor because you're just buying more of whatever is going up. And second, that index is not representative of the world. Think about the tiny part, for example, that the Chinese market makes up in the world MSCI market. And there's all sorts of reasons for that. There's governance issues, there's free float issues, a lot of stuff going on. But the point remains that active decisions have been made by the people who create the index in the first place. So even if you buy the widest passive instrument you can, you've still made an active decision, or rather someone else has made active decisions for you. If you decide to have an active portfolio of the kind that you construct, someone is making decisions. In your case, you're making decisions about how people should allocate their assets using passive vehicles. But that is not passive investing. That is active investing using index-linked vehicles along the way. And this, I think, is something that is very confusing for people. And in a way, I feel slightly guilty here because I spent a lot of my career promoting index tracking vehicles on the basis that they're much cheaper. And I'm not sure I spent enough of my time explaining that's still an active choice. And you have to take that into account. So we hear this sort of this difference between passive and active that doesn't exist in quite the way that people think. And one of the things I've been talking about recently, I'm fascinated by, and you will remember, Charlotte, we've both been in this business for a long time, but you'll remember the days when we used to relentlessly complain about the closet trackers, right? Funds that said they were active and charged as though they were active. That'll be 1.5%. Thank you, madam. And weren't active, just tracked the index anyway, but you had to pay for it. And then we were like, we're not doing that anymore. And we started using proper trackers, passive trackers, we've just been talking about, charging us 10, 15, 20, 30 basis points, whatever. And now if you look at a lot of the passive vehicles, you'll find that they're active. Either they're very concentrated, that they're trying to represent an index only using a smaller number of stocks than you would expect. And also that very often they massively outperform the index. That's not okay. You don't want your index tracker outperforming the index. It feels like we kind of come full circle from...
I think part of the reason for this, and you have, as you say, you've been a very active commentator on this. I have in our way, with Netwealth, we're really trying to help people understand this is active allocation, passive implementation. But I think it comes round to this point around cost. So the good thing that's come out of this is people recognizing that actually you can pay much less, and paying less will have an impact on long-term outcomes, but understanding that you're getting something different for paying less. So I'm very happy with at least the fact that you've championed this for a long time, as have I. And I think there is this better understanding now that you can get more for less, which you
Absolutely.
But let's move on to another part of investing, which I think is so fundamental to the UK, and that is our obsession with property. And it really is an obsession, I think, in that unless you own your own place, somehow it's not okay. And I think about particularly the next generation now coming into the workplace. You look at property prices, although I have to say London is going down in double
tanking
as we speak. But assuming that won't be the case forever, do you think that younger generations should rethink the idea of home ownership as the sort of ultimate financial goal? Because it's quite material as you start to build your wealth, whether you're always thinking about this as being the kind of anchor of everything.
Yeah. Well, look, the first thing to say is that it's really great to own your own home. It's absolutely lovely to live in a house that you own. It's a perfectly reasonable goal, and it should be a goal that is achievable for everybody. If you work and you save, you should be able to buy a house in which you want to live. Now, there have been all sorts of government policies that have made that difficult. Supply has been cramped. Prices have been pushed ridiculously high by credit being far too cheap. Stamp duty is much too high. So we see people not wanting to buy smaller houses or flats when they're young because they're not going to be able to avoid the stamp duty, or to want to pay the tens of thousands of pounds in stamp duty to move every time. So the market is very badly constructed, and the government has done everything it possibly can along the way to make things worse. Not just this government, the previous government, and the government before that. This is across the board. They've made an absolute mess of the housing market. And I don't know if you saw recently Rachel Reeves talking about maybe she's going to put on rent controls just to see if she can make things even worse. It's extraordinary the mess they make of this stuff. But the question is, how do you focus here? If housing is too expensive, okay, now let's look at it a different way. The problem is with thinking of a house as an investment. And that's the problem we've always had. One of the things that's driven me mad, and I used to tweet about it all the time, but I've given up now because sometimes you just got to let it go. The things in the back of the personal finance sections at the weekend where the question is actually pension or property. Pension or property. And this is not a choice. And then people go, oh, my property is my pension. It is not your pension. Your house is your home. These are two completely different things. And so there is this problem that you've identified with people looking at their house as an investment. It isn't. Now, we're seeing the disappearance of buy-to-let investors across the board, because with wave after wave of tax regulation, it's basically impossible to have an investment portfolio in the way that it used to be. So now people are much more focused on just having a house, one house, and that's much better. And we are seeing the beginnings of a correction. We always say that house prices are a function of the price of credit, and you can go on about supply and demand as much as you like, but demand only exists as long as people have money to change I want something into I can afford something. So there's an awful lot of talk about pent-up demand, which of course does not exist in economics. There is only demand, only a desire for something which you can afford to pay for. A desire for something that you cannot afford to pay for is not demand, right? So the price of a house is a function of the price of credit. So our extremely rehab prices are a function of 40 years of very low interest rates, and in particular of that period of insanely low interest rates up and around through COVID, right? And now interest rates are normalizing, so we see house prices normalizing. So if you look at house prices back over the last 10 and 20 years across the UK, you will find that over the last 10 years in almost every area in the UK, house prices have fallen in real terms, in inflation adjusted terms. That's even the case in London. Over 20 years, not so much. But even though you haven't seen huge rises in real terms, nature heals, right? And the housing market is healing. So I hope we're not that far away from a point when it is entirely possible to both own a home and invest. But the key is to look at them as separate things. My home, my portfolio, these are different.
I think I'm so pleased you said that, because it is a comment that we hear quite a lot in terms of people not differentiating. I think the other thing is this question of what is liquid, visible, transparent versus something which maybe it feels safer just because it's less transparent and therefore you don't have the price discovery. So let's talk about the other side of the equation. So you've got property on the one side. Let's talk about pensions for a minute, because I think you have spoken about this on the podcast recently as well. It's fascinating where we have got to. Let's start with auto enrollment and recognizing that obviously you can also invest into your own SIP, but it's been very effective in terms of getting people to contribute to their pensions, take part of their salary, put it in, save every year, know you're doing something for the long term. You can't do something. That's all good. But it's very clear that it's not enough, and that people's pensions are going to be underfunded and not helped by the fact that salary sacrifice rules are evolving as well. But when you're talking to people about pensions, then recognizing there is a level of price discovery, but you can't actually go in and spend it for a long time. How do you think about pensions?
Actually, I want to pick you up on it's not enough. It depends what you mean by enough. So I think when we talk about pensions, we need to start with what is it that a pension is supposed to do from the point of view of the government, not from your point of view or mine, but from the point of view of a government. So tax relief on pensions is supposed to get the majority of the population to a point when they will not rely on the welfare or benefit system in their retirement. And the auto enrollment system works very well for that. So if you are in a median salary job for a working lifetime, which is assuming that you're going to get a job and you're going to keep it and you're going to stick around the average wage or maybe slightly below, when you get to the end of your working career, assuming you have remained opted into your auto-enrollment pension system, you will have a pot that, when turned into an income and added to a full state pension, will provide you with around 22, 23, 24,000 pounds equivalent of, which is enough to keep you outside the welfare system. Right. So if you're on pension credit, if you turn up at 67 or 68 with not a penny to your name, and you go to the welfare system with your pension credit and your housing benefit and your blah, you'll come out at about 24 grand right now. This will change over the years, obviously. So my point being that it depends on what you think is enough. From the point of view of government, auto enrollment is enough. Right? Is it enough to live a great life? Of course it isn't. Of course it isn't. You have to supplement. You have to supplement along the way. And it's also worth remembering, by the way, that auto-enrollment contributions can be cut off at a salary level of around 50 grand. Your company does not have to give you 3% above that. So you might, or 5% above that. So you might find that you have slightly less in your pension than you thought. But and now I've rambled at you, Charlotte, and I've forgotten the question.
I was just thinking about pensions generally, because ultimately, I think it's so important we all remember that the government gives us, this government, previous governments, they give us these allowances every year. And I'm always interested by the degree to which actually sometimes people don't take full advantage of this. Or sometimes we grumble about not having enough of this, enough of that. But meantime, actually, we should be recognizing pensions and ISAs are there for a reason, and they're both very tax efficient, and they can be very helpful in terms of building for you and your family, if you have one, tax efficient returns.
Yeah, and they are actually. I would say that there is very little that is generous about the UK tax system, and you may say you prefer to have fewer in the way of tax avoiding allowances and more in the way of not having to pay quite so much tax on your salary in the first place. But if you put that to one side, you can still put a pretty reasonable amount into an ISA every year and a very reasonable amount into a SIP. You can build up an excellent long-term tax protected pot by using your allowances properly. The problem here is that, as ever, that a government cannot stop making it complicated. And the ISA system used to be absolutely beautifully simple and straightforward, and now it's not anymore, and that is insanely irritating. And the pension system as well. People don't really know what to think about it because the rules are changed every year. There's another complication, another change, another cut to an allowance, another difference to the calculation of your net income for this and for that. It gets very complicated. People find it very difficult. And so they back away from it. And this comes back down, of course, to trust. People don't trust this stuff. And you should be careful, of course, about trusting anything that you have in your pension. You think it's yours, but it's not yours. It's not yours because inside a pension wrapper, and it is being built up with tax relief. And that gives the government, whether you think this is right or not, that gives them some say over it. They can take that money, not take it out, but they can insist that you spend it on something you don't want to spend it on. Invest. The great story about bank robbers. Why do you rob banks? Because that's where the money is. Why government's going to come for your pension? Because that's where the money is. And so over time, as the UK debt becomes increasingly unsustainable and our need for infrastructure becomes increasingly intense, it is very likely that you will find that a certain part of your pension is mandated to be spent in one particular area or the other. Now, that's being fought at the moment, not in SIPs, but in other pensions. But it'll come to the SIP. It'll come to everything. So I always say to people at this point, fill your ISA first. Just fill your ISA first. That was a different equation when you can inherit a pension, but you can't anymore, not in the same way, not IHT free. So now the tax rate on your pension at death, combining income tax and IHT, can be ridiculously high. So ISA first, pension second.
Interesting, because you think actually that would be the place they will go. That is really interesting. And obviously there's a huge debate at the moment about private assets, private credit, private equity. And this is what infrastructure investment in Britain potentially being people's pensions being directed towards that.
Absolutely.
Which sounds fine on the face of it for a small proportion. But I think you talked about this recently as well. I think Nest are going to put something like 40% of their assets by 2030 into private assets, which
we did a podcast on this the other day because it really bothers us. This is not that we don't believe this is the correct home for retail investor assets. Your pension should not be fulfilling the needs of government. That's not how it should work.
Do you think, related to that, actually in the end, investment money finds its way to performing assets? So in other words, does it need to be mandated? Because in the end, the market's efficient. And the reason people have been buying the US is because actually it's been one of the best performing markets.
Do I think that it should be mandated? No, I do believe actually that if you receive tax relief, it is not completely wrong for you to be actively encouraged to have a home bias. So I am not against, for example, the Brit ISA. It seems to me perfectly reasonable that you should be encouraged to invest in the UK. And people say that's outrageous. And I'm like, we're perfectly welcome to invest outside this vehicle any way you like. But if you want to get tax relief from UK taxpayers, other UK taxpayers, then why don't you help bring down the cost of capital in the UK by having a domestic bias inside your portfolio? I think that is absolutely reasonable. But I am talking here about listed vehicles. What I want to see is a domestic bias from ISA and pension investors that reduces cost capital in the UK and also keeps the UK listed infrastructure and environment going, the legal environment, the accounting environment, all the jobs and expertise that stem from having a very active stock market in the UK. I wouldn't mind having a Brit ISA that allows you to invest in listed UK investment trusts that actually invest in Korea. I have no problem with that. It's the infrastructure of the stock market in the UK that I feel really strongly about. So I don't mind that kind of mandation.
But if we then to go back to that Nest example, I think of the private equity that they're investing in, it's all US based.
Yeah,
so
it's almost all US.
Not only private, it's almost all US. So it doesn't achieve anything in the context of helping Britain get more productive and get these cash flows working.
Absolutely not. And there's also no evidence of any kind whatsoever that it will provide superior long-term returns. There is no evidence that any of the returns from private equity over the last little while, and there's still argument actually about whether those returns are superior to the returns on listed vehicles or not, and increasing amounts of research suggests they are not. But to the extent that they might have been, it does appear that is all simply a function, again, of very low interest rates, which we no longer have. So the idea that you could right now say to yourself, oh, I know what we'll do. We'll take 40% of our clients' money and we'll shovel it into private assets in the US. I think it is not entirely responsible. And it is one of those things where I feel strongly that an element of financial democracy should be introduced. The people who, and right back to what is a company, what is a share, the people whose money is invested in Nest, most of them will only know that they have an auto-enrollment pension. I have a pension. They don't know what a pension is. They don't know what is inside a pension. They don't understand the assets held inside the pension. And nobody has told them. There is no email arriving to people who have assets with Nest saying, by the way, we're doing this private credit thing, and this is what private credit is. How do you feel about it? Click here for yes or no, which I feel would be very valuable democratic information discovery for the big fund management companies and pension funds.
Yeah, it goes back to financial literacy, however we want to term it. It's confidence that you have some idea of what's going on with your money. We're almost out of time, but one of the things that I think it would be nice to hear from you is, I think I know what you're going to say, but people think that you take what's going on right now, geopolitically, around the world, sorts of uncertainty, difficult conversations in government, just lots and lots of reasons why people might think that now is not a good time to invest. And do you think that is true? Do you think are people right to think there may be better times to invest? Or how do you think about that? How would you articulate it?
And there are always better times to invest, but I have no idea when they are. History shows us that there are occasionally absolutely appalling times to invest. The absolute peak in 1929, for example, the absolute peak of the dot-com bubble, for example. But those times are impossible to spot. I don't know when the better times to invest are. I don't know when the worst times to invest are, but I do know that when you are investing, you want to be diversified. You want to have an eye to value. You want to not put everything in at once. You want to drip feed, etc., etc. Put your money in monthly if you can. All these old standard strategies for long-term investing. Because you asked me at the beginning, what is different now? In that sense, nothing is different now. Nothing is different now. You need to do exactly the same things that you've always done. And look, if there was a better time to invest, I would definitely tell you if I knew, because I would be waiting for it too. But I don't know when it is. I know there are times when it is best not to be in very expensive stocks and times when you should be looking for cheaper stocks. And I know that you should be diversified across different markets. And for me, this is a very good time to maybe look at your portfolio and say, have I got a bit too much America? Maybe this is expensive. Things are a little weird. Maybe I should be more diversified. And that was very much the case at the beginning of last year, right? And anyone who diversified out of the US last year did really well.
Actually, last year was so interesting, I think, because if we were having this conversation early last year, we would have we could have come up with a list of 10 reasons that would make you feel like there's some significant headwinds to investing.
Yes.
But we would have said, nevertheless, no, be invested. That's still the right thing to do. And lo and behold, at the end of last year, despite everything, double-digit returns all over the place. And anyone who sat in cash, meantime, was really not picking up very much.
Yeah.
It does.
And all those markets are more expensive now. If you look back to the beginning of last year when I was sitting around talking to people about where one should invest, this was easy. It was so easy. Look, Europe is so cheap. Japan is still so cheap. UK is still so cheap, etc. Why would you not just pour money into those and sit back and wait? And so that worked very well. This year is harder. It is harder. But no one can possibly know what will happen next. Just stay away from expensive stuff. Be diversified. Have cheap stuff. Have some gold. Hope for the best. That's not advice, by the way. That was not financial advice.
None of this is financial planning advice. That we're definitely agreed on. Look, I think it's always great talking, Merryn. I would definitely recommend for anyone listening to this that they go and listen to your Merryn Talks Money podcast that you do with John Stepek, because it's so interesting. And I think it's really nice the way you do these bite-sized pieces and really just try to address one or two things at a time. I'm always pleased when you're talking about being clear about transparency and lower cost, and just do the sensible things. But also you're trying to lift the veil on some of the areas of investing that people may not be as familiar with. Hopefully a few more people. I know you've got huge numbers. How many people are listening to the podcast now?
I'm not allowed to tell you that kind of thing. Commercial secrets.
Okay.
But lots. It's been wonderful. It's been wonderful. We got lots of great feedback and lots of great reviews. And it's also, by the way, great fun.
Actually, one last question on that. Is there a single thing that keeps coming up when people write in terms of questions they have for you or concerns? Would you say there's a highlight item?
Yes, I would. There are a couple of property prices always come up over and over again. When do I buy a house? Should I buy a house? Et cetera, et cetera. But the other thing is IHT. People worry a lot about IHT. How do I pass money down? How do I do this right? Which wrappers do I use? People worry a lot about, and the great wealth transfer is so interesting, right? And it's also not going to be nearly as big as we all thought because of house prices falling, right? A lot of people think they're leaving their kids an awful lot more money than they are. And there are a lot of young people out there who think they're getting an awful lot more money than they are.
We will leave that for another time. But for now, thank you so much for the conversation today. It's been great.
Pleasure.